Hi, it's Jenny Kassan here to lay down the law and give you some inside information about how to raise money for your business in a way that lets you stay true to your mission, lets you stay in control of your business, and also do it in a way where you don't break the law. So there's a couple pieces to the legal part of raising money. You've heard me talk about it a million times if you've been following me. There's the what you're offering, and then there's the how you're offering it. The how you're offering it is securities law, and that has to do with what are you allowed to say, who are you allowed to talk to, who is allowed to invest, and we're not going to talk about that today, but I thought it'd be cool. One of the things that I love to help my clients do is design creative offerings for their investors, because your relationship with your investors is laid out in a legal document. There's some kind of legal document that tells you and your investors like what your investors' rights are, when they're going to get money, what would have to happen for them to get paid. And there's so many different ways to do that. And so I just think it's really important not to use a cookie cutter approach and to choose choose a type of offering and an offering structure that really fits with your particular goals for your business. So, it's really common for me to have clients that don't want to be pressured to sell their business before they're ready. And they don't want to be on that pathway where they're solely focused on like, how do we become an acquisition target? How do we sell our business? Because that's the only way that anyone's going to make any money. So, if you've been around the world of like Silicon Valley investing, you'll hear a lot of talk about exits, and that's the goal. An exit is the goal because that's the only way anyone makes money. So, most of my clients don't want to be part of that system because they don't want to be pressured to sell their business before they're ready. So we need to come up with other ways for investors to get paid along the way, before there's any kind of an exit. And maybe there never will be an exit. We don't know. So I just thought it'd be fun to share an example of something I came up with one of my clients, just to kind of give you a sense of how you can be kind of creative. So this particular client, and we always talk about what you offer to your investors. You really want to make it customized to your situation. Like some businesses have pretty low margin and maybe are never going to be super profitable. Other businesses have a pathway where they could become really big and really profitable. And either way you can raise money, but you just want to make sure that you design your offering to fit your particular situation. So in this case, this is one where it's a real estate related project, and it has the potential to become profitable, but it's not like a tech company where it could just kind of go through the roof and become super huge and super profitable. There's somewhat of a limit on how profitable this business could be because it's based on a physical place, a physical building, and the revenues that come from the rents in that building. And but, if it does well, then it could be fairly profitable. And my client owns the building, so he doesn't feel a need to necessarily make a ton of money off of this business. He obviously wants to have reasonable return on his investment, but he wants to be generous with his investors, which I love because, your investors make it possible for you to do what you want to do. So if you're able to be generous, I would never push anyone to be more generous than is reasonable for them. But if you're able to be generous, it's great. So I just want to share what we created together. So what he's going to do, so it's going to be an equity investment, which means that, there's no right to get paid back for the investors, but what we are giving them the right to is to get dividends. And dividends are basically a share of the profits. And so I'm just going to give you a little summary of how we designed this particular one. And it'll just give you an idea of a creative way you could design an offering for an investor. So what they're doing is they're saying, we're going to have a target dividend of 8% per year. And that means that whatever amount you invested as an investor, like if you invested $10,000, then your dividend would be $800, 8% of 10,000. Is that right? Yeah, I think it is. So your target dividend is $800 a year, 8%. That's a pretty good return. It's hard to do an investment these days that pays 8% consistently every year. Because as you know, like if you put your money in a bank or a CD or something like that, it's going to pay probably less than 1%. So 8% is good. And they don't have to pay 8%, but that's the target. And they are promising that unless they pay at least that 8%, that the founders, the guy who's starting the whole business isn't going to take out any profits for himself. Of course, he will pay salaries and other expenses, but he won't take out any profits. So, but let's say, what if the company becomes incredibly successful and it gets to a point where 8% isn't that high anymore, because it's like, wow, you could actually afford to pay us more than 8%. You're doing so well. So what they're going to do is every year they're going to look at their net revenues, and they're going to subtract the dividends that they've paid to their investors, the total amount of dividends paid. And if that number is greater than $100,000, then they will pay an additional dividend of the amount exceeding everything above 100,000. They're going to pay out 20% of that to their investors. So they're going to divide it pro rata among their investors depending on how much the investors invested. So that's really cool. So basically they're saying, like, the better we do, the bigger of a dividend you get. And until they do, they don't have to pay that again because it's still at their discretion. But unless they do pay that, then the founder cannot take out any profits. So there's really no limit on how much the investors could get if the company does really well. And then let's say it's been a great year. They've paid out the 8% target dividend. They've paid out that excess dividend, which is the 20% of the total revenue over 100,000 minus the dividends that were already paid. And then the common shareholders say, the founder says, okay, we've paid out everything we said we would pay out. Now we want to get paid as common shareholders. We want to take out some profits too. So the common shareholders can at that point take out profits, dividends, at the same rate as the preferred. So they would get the same, based on their percentage ownership, they'd get the same return as the preferred. And then once they take that amount out, anything beyond that has to be shared among all shareholders. So it wouldn't be a situation where the common shareholder could take out a whole bunch of profit and then just keep taking out more, and the preferred would be capped. So the preferred they're uncapped in terms of the preferred investor. The preferred are the investors, by the way. So it's just a really neat example of a way that you don't have to pay anything to your investors, but if things are going well, you can, and they feel comfortable, even though they have no guarantee that they'll get dividends. What is guaranteed to them is that legally you as the founder of the business are not allowed to take out profits unless they get at least the target plus that excess amount if the company is super profitable. So that's just one example of a creative way that your investors can do really well while making sure that, the company is sustainable. This all comes out after expenses. So you definitely don't want to skimp on expenses. You want to pay people good salaries. You want to have the best possible, recycling program and all of that. And those things all come off before, you pay a dime to investors, which is the right thing to do. So that's just one example. And then of course there's a whole other provision that I won't talk about today that has to do with how an investor would exit if the company's not sold. We call it a structured exit. So there's ways that investors can exit even if the company is not sold. But I thought for today I would just focus on that dividend equation. And this is just one example. You can do this however you want. Pretty much there's not a lot of limits, as long as you stay within the law regarding paying out dividends. And the law just says you can only pay out dividends if the company is solvent. So I just thought I'd share that as an example. I hope you enjoyed hearing about it, and it sparked some ideas for you if you're raising money about creative ways that your investors could get compensated where you wouldn't have to sell your company in order for the investors to get paid. All right, so if you like hearing about this sort of thing, and maybe you're interested in raising money for your own business and you're trying to figure out how, or maybe you're also interested in becoming an investor, I love to support everyone who wants to get involved in this space. So if you want to learn more about all the different ways you can become more of an expert on investing and raising money, you can just go to my website, jennykassan.com, and you can sign up for my monthly newsletter. And, there's also a lot of other free resources on the website. So thank you for joining me. I look forward to seeing you next week. Bye.